Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers.
Today's agenda covers 5 core areas. First, the price echo. Second, OpEx versus CapEx architecture. Third, rhetoric versus balance sheet. Fourth, 3 quantitative conviction metrics. And finally, the strategic execution playbook. Let's jump right in.
Section 1. The price echo, the failure of retail rhetoric.
So let's address the fundamental flaw of the modern retail trading landscape, this dangerous obsession with lagging geometric chart artifacts. Look, there is a massive structural divergence in the market right now. The retail crowd honestly believes direction is driven by short-term sentiment, moving average crossovers, and RSI, but they're categorically wrong. Price is merely an echo. Those candlesticks printing on your screen, they're nothing more than the lagging artifacts of irreversible capital allocation decisions made by elite institutional allocators months or even years prior. Institutional money literally does not care about chart geometry. They care about structural alignment, long-term capital deployment, and hard physical infrastructure.
Moving to Section 2, OpEx versus CapEx architecture, the accounting split. To build a definitive edge and actually read corporate conviction, you've got to master the absolute accounting boundaries separating how a company deploys its cash. Think of it like this. Every dollar flowing out of a corporation falls into one of 2 fundamental operational buckets. Operational expenditures, or OpEx, are short-term costs instantly consumed just to maintain present existence. They hit the income statement immediately, fully deducted from gross revenues. OpEx doesn't build capacity, it literally just keeps the lights on. Capital expenditures, or CapEx, on the other hand, represent long-term investments in physical expansion. We're talking new manufacturing plants, real estate, or multi-billion-dollar data centers. CapEx gets capitalized on the balance sheet under property, plant, and equipment. The distinction is absolute. OpEx is basic maintenance, CapEx is a mathematical investment in future structural dominance.
Section 3. Rhetoric versus balance sheet. The executive illusion. Retail consistently buys market tops because they commit one fatal analytical error. They confuse malleable forward guidance with the absolute mathematical ruthlessness of the balance sheet. We hear statements projecting unprecedented demand for upcoming product cycles on earnings calls all the time. But remember, executive teams are structurally incentivized to project unbridled optimism. Their stock options and their professional survival literally depend on keeping public market sentiment high. So they use cheap linguistic framing that momentum algorithms and retail traders just blindly buy into. Verbal commitments cost absolutely nothing, and they're regularly walked back without legal consequence when market conditions turn sour.
Because words are cheap, right? Steel and concrete are not. If an executive claims massive incoming demand, their verbal conviction is entirely irrelevant until it's proven mathematically. True conviction is only validated when a corporation's CapEx budget compounds at 40% year over year. That specific metric proves a board of directors is willing to completely lock liquid cash into physical, illiquid assets. You can't easily reverse a multi-billion-dollar infrastructure build-out. An expanding CapEx budget is the unvarnished blueprint of a company's strategic belief.
Section 4. 3 quantitative conviction metrics, the mathematical framework.
To extract actionable, repeatable data from the statement of cash flows, we have to compute 3 core metrics of corporate intensity. Metric 1 is year-over-year CapEx velocity. This formula measures the precise rate of change in corporate investment. Think about it. If a company's stock price is just consolidating sideways, but its CapEx velocity is quietly accelerating from 5% to 35%, you have a definitive signal. Corporate insiders are actively preparing physical infrastructure for an upcoming wave of revenue way before it ever hits the public income statement.
Metric 2 is CapEx to revenue intensity. This calculates the exact percentage of top-line revenue being actively diverted from immediate profit margins into physical reinvestment. A sudden doubling of this ratio reveals that the company is hitting critical capacity constraints. They are forced to build right now to capture future market share. Conversely, if this ratio falls near 0 in a mega-cap tech stock, it means management sees limited high-return opportunities and they're simply coasting on legacy infrastructure.
Metric 3 is cash flow coverage. This determines exactly how much of the cash actually generated by a company's core operations is entirely consumed by its physical investments. When this metric approaches or exceeds 100%, that corporation is executing a maximum conviction play. They are leaving zero margin for error, aggressively betting their entire operational engine on the physical capacity they're building today. Which brings us to Section 5, the Strategic Execution Playbook, the Quantamental Framework.
With our quantitative tracking dashboard constructed, we now shift our focus to strategic deployment, utilizing a strict two-step framework to actively front-run the market. Step 1 dictates fundamental selection. We actively filter the market for companies boasting high CapEx intensity and velocity, yet whose underlying stock prices remain depressed by short-term noise. We're locating discounted assets that are actively building tomorrow's commerce lines. Step 2 is the execution of the supply chain front-run. You see, every massive capital deployment by an industry leader creates a very predictable physical domino effect.
Consider the actual mechanics of capital flow. If Tier 1 sector leaders suddenly expand their CapEx budgets by $50 billion, you don't go buy those top companies at a premium. Their expenditure is someone else's incoming revenue. You map exactly where that cash has to land and immediately allocate capital into the specialized component manufacturers, the raw material producers, and the Tier 2 engineering firms holding the contracts for that physical capacity. You buy the suppliers at a deep discount before those upcoming quarterly earnings surprises ever hit the retail crowd.
Look, financial markets represent a continuous battleground between transient noise and physical reality. Price action is easily manipulated by algorithmic liquidity and coordinated PR, but corporate capital allocation, it absolutely is not. By mastering the strict accounting boundaries of CapEx versus OpEx, you completely insulate your portfolio from the emotional, erratic swings of the retail crowd. You track precisely where the physical money flows. When billions in treasury cash are authorized for heavy physical assets, the paper narrative ends and industrial reality begins.
In a market this split, you're either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.